So as you probably already know, the Bank of England's Monetary Policy Committee held the base rate at 4% today. But it was a close call with 5 members voting to hold and 4 members voting to cut the rate to 3.75%. But fasten your seatbelts, buckle in, because this is going to be a long one. There's a lot to unpack from this. Today's meeting is quite a big moment. The bank really is signalling that interest is under control, but they're not ready to claim victory yet. In their summary, the MPC said that inflation had peaked, and the process of underlying disinflation was continuing, meaning prices are now rising more slowly. They've seen both pay growth and service inflation easing, which is really suggesting that those high rates we've had for the last few years are doing their job. But the majority of the committee argue that although the data looks promising, we need to see a bit more evidence before cutting rates further. They really don't want to risk dropping rates too soon and inflation bouncing back up again. The Governor, Andrew Bailey, one of the members who voted to hold, said he's seeing a much more balanced risk now, and that inflation might keep falling, but he wanted to see more evidence of it over the winter. Other members like Megan Green and Catherine Mann are still focused on the risk of inflation persistence. Basically, that people and businesses have got used to higher prices, which could potentially make inflation harder to squash. Whilst on the other side of the debate, there was 4 members wanting to cut the rate down to 3.75%. Their argument is that disinflation is already well established, and as a result, the economy is starting to show weakness. In short, they're worried that if rates stay high for too long, we could very well tip into an unnecessary slowdown in the economy, and even an inflation undershoot in 2026. Key line in the committee's minutes is this: if progress on disinflation continues, then the bank base rate is likely to continue on a gradual downward path. And that's about as close as the Bank of England ever gets to saying, yes, we're probably going to see rate cuts in 2026. But the big news isn't that they held rates at 4%, it's that we're already seeing those future rate cuts being priced into the mortgage market. Nationwide, for example, in the last week have cut their headline rate to 3.64% on a 60% loan to value. And that is one of the lowest rates we've seen in ages. So that shows us that lenders are already anticipating rate cuts. They're pricing it into their fixed rate deals. They're basically anticipating the base rate's peaked and we're going to see it easing next year. Well, if you're on a tracker or a variable rate mortgage, then there's no change for now. We could see cuts coming next year, which would be great for everybody. But for fixed rates, lenders are already starting to adjust, with some headline rates drifting lower as competition re-enters the market. This week's meeting has absolutely confirmed that the Bank of England is shifting away from fighting inflation to managing the landing. It's not a rate-cutting cycle yet, but it's the clearest signal we've seen that those cuts are coming. I'm Patrick Weightman, your local East Midlands mortgage and protection advisor, and if you want to get in touch, my links are in the bio. Speak to you soon.